I hope you can see me and hear me. My name is Wangoi Karuga. I am a partner at MAK Partner Advocates, and it's a pleasure to be before you this morning to discuss a very topical subject, which we have called Beyond the Booking, Navigating the Finance Act 2026 and the Emerging Tax Compliance Realities for members of the travel agents. I would like to allow me to share my screen again so that I am able to scroll down. Share. Okay. Wonderful. So that is me in a nutshell. My name is Wangoi Karuga, as I have mentioned. I'm a partner at MAK Partners Advocates. I am an advocate of the High Court and a chartered accountant with ACCA, with over 13 years of experience in carrying out tax matters. Previously, I have worked with KPMG, where I started my career, and I also worked in a law firm called ALN Kenya and Jawala and Kana before joining MAK Partners Advocates to start the tax practice. It's a pleasure to be before you. I have worked with KATA in the past, and I hope this training will help us understand the issues facing KATA members in the tours and travel agent space, in line with the recent changes in the Finance Act and also just the broader tax compliance conversations. In a nutshell, our law firm is a full service legal firm, and those are the awards and accreditations that we have had in the past. We have been ranked by the African Legal Awards in 2025 twice, and by the Nairobi Legal Awards under the LSK branch in Kenya as the SME Law Firm of the Year of 2025. So on to the conversation of the day. We are going to look at the Finance Act of 2026, the key changes from the Finance Act that have affected members. And as we know, the Finance Act makes changes to various tax statutes, the Income Tax Act, the VAT Act, the Tax Procedures Act, the Excise Duties Act, and Miscellaneous Fees and Levies Act, and sometimes even other statutes like the Stamp Duty Act. So for the purpose of this training, we shall restrict ourselves to the changes which we felt were of importance to members of KATA. Then we shall look at a few landmark judgments that have shaped how policy has been created and developed, and how KRA has subjected such organizations to audit and the decisions that have come from the tribunals and the High Court. And lastly, we shall just look at the compliance reality affecting KATA members in the new digital tax enforcement framework that has been rolled out by KRA, especially in the Finance Act of 2026, and also the way forward for members, together with a compliance checklist of how to reduce our tax exposure and to be compliant. So the Finance Act was assented on sometime in June with an effective date of 1st of July 2026. As July comes to an end, most of the provisions are actually in force, and it is good that we're having this conversation now so that to enhance compliance in months and days to come, to avoid any instances of non-compliance and being caught off guard by KRA. So into the topic of the day, what normally happens as the budget and finance cycle is developed, we are allowed to carry out policy engagements and also public participation of the Finance Act. So what happened this year is there were a few policy conversations that happened, and we were able to lobby to a great extent on various issues. And some of those were consequently dropped, and I'll highlight a few in this presentation. So one of the main proposals that was there in the bill was the issue of deemed dividends distribution, which then empowered the commissioner powers to consider a deemed distribution of profits after tax that have not been distributed to shareholders of up to 60% of such undistributed profits. This was going to have very adverse consequences and impact to many companies, including members of KATA, because we understand that it is important that you hold a bit of, retained earnings and profits to manage your cash flows as and when you need to buy tickets and before you receive payments from your customers and clients. So the lobby efforts that were put in by various professionals, including ourselves, so that that provision dropped by the in the Finance Act that was assented. We also saw a few very important policies around the Tax Procedures Act, which were dropped. One of them is the agency notices during appeal. So what that does is we have seen in the past that KRA has sought to introduce this proposition with every new Finance Act, and the idea behind it is that when tax has been found due through an assessment before you appeal, the intention of the government was that we pay the full tax and then we appeal. What we have in the past called pay to play or pay now and argue later provisions. And so that would really hinder access to justice, because you'll be required to put in the amount of the assessment which KRA has determined and which have not been rightly found due for before any appeal is made. So that was dropped. And also the issues around counting of days in regards to filing objections and also filing appeals. Previously, we used to count only working days. So in a calendar day that has 30, 31 days, you'd be left with around 20 days to put in an objection or file an appeal. That was also dropped. And now the law as it reads in the Act is what was there previously, where we only file appeals and objections using calendar days. So we have a longer time to put in a robust objection or to put in a robust appeal. There was this very big issue on VAT on money transfers, and it was highly, highly lobbied by big players, including Safaricom, where money transfer services were proposed to be subjected to VAT. That was dropped. And we also saw a bit of filing deadlines that KRA had proposed to be accelerated, where companies would be required to file their income tax returns within 4 months after the end of their year end. Unlike the current regime of 6 months, that was dropped, with individuals also being required to file their returns at the end of the first month following their year end. So that would ordinarily fall at the end of January. So those proposals to have shorter filing timelines were dropped in the bill, and the Act made better proposals where companies would still file within the 6 months and the individuals would file within the 4th month unless you're a nil filer. So those are some of the proposals that we saw in the bill that would have adversely affected members, which were subsequently dropped. And now what we will cover are the income tax changes that will affect members. So one of the key proposals and amendments that we have seen in the Finance Act 2026 are changes around withholding tax treatment on two aspects of payments. So the first one is management and professional fees, and the second one is royalty. And a third one is a VAT change that we shall further discuss. So what we've dubbed this slide is that we have seen three separate amendments that actually affect a card booking or a booking that is made through a card transaction. So most of the bookings that people will make would be from credit cards or debit cards. And what we have seen with this passing of the act is that there's a change towards the definition of management and professional fees, which has brought to tax merchant fees and interchange fees. And there's also an expanded definition of royalty, which has brought to tax within the royalty framework what we call platform access fees. And from a VAT perspective, we have seen that there's also an introduction of digital financial services on payments provided by payment service providers. So your processing fees, your settlement fees, those have been brought to tax under VAT. So under a typical card transaction that someone would make to place a booking, withholding tax would be applicable on the bank's interchange fees and the customer's merchant fees. How that works is withholding tax is an advance payment on income tax that is deducted on payment of certain classes of payments. And now with the introduction of merchant and interchange fees as part of management and professional fees, then withholding tax applies. While this amendment seemed to probably just affect payments within the banking sector, that is not quite the case, because merchant service fees would affect any payment that someone makes on a card through a point of sale device. So if I come to you and I swipe my card, then a merchant service fee or commission would be payable under the withholding tax framework. So we see that those three kind of payments and taxes that have been levied on at the point of those kind of transactions have now impacted how card bookings will be made. And while withholding tax is purely an advance tax and to help the Revenue Authority collect money sooner and not a different type of income tax, what we see is because the cash has to be deducted and remitted to KRA within 5 working days as the law prescribes, it creates an administrative burden, and it also creates how contracts are negotiated with some of these players who will require gross up provisions, especially the non-resident people. So into how these definitions will practically work. So management and professional fees is any payment made in consideration for technical, managerial, agency, contractual, professional, or consultancy services. The Finance Act introduced this definition, amended this definition to further introduce interchange fees and merchant service fees arising from transactions that use card as a means of payment. So it therefore means that banks and financial institutions and persons using card payments need to sort of compute a withholding tax, especially on this merchant service fee. And how merchant service fee works is the fee that the bank earns from allowing you to use that point of sale or facilitating and perfecting that card transaction. So there are a couple of challenges that arise with introduction of merchant service fee to withholding tax. And one of them that we have highly interacted with is the fact that at the point of making a card transaction, I do not have any visibility of how much merchant service commission the bank will be earning from that transaction. So it is very difficult for me to say I will withhold on the fee that the bank earns. The second problem, especially now with interchange fees, where it is fees paid by the acquiring bank to the issuing bank for each card transaction. So there are various parties within a card transaction. The issuing bank is the bank that issues me, the person making the booking with my card. So for argument's sake, Standard Chartered. The acquiring bank will be the bank for which the booking line banks with. So for argument's sake, say ABSA. So there's a bit of interchange fee between Standard Chartered and ABSA in perfecting that transaction. So what normally happens is these payments go and sit with the card companies, your Visa, your MasterCard, and then through a settlement scheme, it is distributed to every platform, to every bank and every person within the transaction. So even for this interchange fee that has been brought to withholding tax, it is very difficult for the banks to know what that interchange fee is or the person completing the transaction, because everything sits with the card company through a settlement scheme. So we see a lot of administrative challenge around how even yourselves as KATA members are going to account for some of these withholding tax on some of these fees like merchant service fee, given the complexity of card transactions and how they happen. I think the third one, which is very, very important and will practically affect most of us here, is on the issue of royalty. So royalty has now been expanded to include the use or right to use of any software, proprietary or off the shelf, whether in the form of a license, development, training, maintenance, or support fees. So this development comes after a lot of litigations that have been in court around what exactly constitutes a payment for use of software, which will be equivalent to a payment of royalty. And in the past, it was very clear that unless I am exploiting the proprietary rights in that software, then payments of licenses were not part of exploiting such rights. So they would not be brought within the definition of royalty and therefore not subject to withholding tax. But with the passing of this act, then, and the way it directly reads in black and white, is that now use of any software or license constitutes exploitation for right to use, which amounts to a royalty. So as we all know, most of us as KATA members use a lot of platforms and softwares, either the office tools or the ones we use from the GDS system. So any use of those kind of softwares now are subject to withholding tax. The second expanded definition of royalty is also a proprietary digital platform, payment network, payment card system, payment processing system, including the switching, clearing, settlement systems, whether or not the payment is described as a service fee, a transaction fee, a network fee, or any similar charge. So then this brings to the ambit of withholding tax any payment solutions and payment platforms that we use. So again, given that we are in the tour operator and airline business, a lot of us have this kind of payment networks, payment card systems, and payment processing systems. So the Act then defines the use of such platforms to constitute royalty, which are subject to withholding tax. Of course, a number of issues arise. Most of these payments are paid through, a card system where you just put your credit card and you pay. Some of them are paid through direct bank payments, and most of them probably we never get an invoice, or we get an invoice after we pay. So there are very many practical considerations of how then do we account for withholding tax before making this payment. And how withholding tax would work is, if you're going to pay $1,000 through a digital payment platform or a payment network or a payment card system, then as you pay the $1,000, you are required to withhold 5% if it's to a resident person, or 20% if it's to a non-resident person. So where these services have been provided by a non-resident person and we're making credit card payments, then we need to withhold before we make the full amount. And that brings me to my next slide. So how then are we able to account and deduct withholding tax on such payments like card acquiring and merchant fees and gateway and aggregator charges, which have been now been defined as royalty payments? So I have highlighted in these slides a number of online solutions which are often used by members of the travel agents. Okay. Confirm that you can see my slide. I'm now on the next page. Okay. Sorry, I have noted that the slides have not been moving. From my end, they seem to be moving. I think to preserve data, allow me to turn off video. We see if that will help. Why they're not moving? Okay, they have, I see we are now on to the next slide. So this is the slide that I was discussing. Yes, so that slide that I'm projecting now is what I have just discussed on the different definitions that have been provided for by the Finance Act as to management and professional fees and royalty. So I was discussing the technicality of how some of these payments would apply to us and how practically it would be possible or otherwise to account for withholding tax. And we see that we use a lot of these kind of systems. So from the GDS platform, we have a few that we use, and most of these are non-resident held. So they are owned by non-resident persons. And then we also have a lot of online booking engines, international reservation platforms, foreign software providers, overseas marketing and advertising platforms. So those are some of the areas around withholding tax that we see the new changes in law will bring them subject to tax. And as I had earlier discussed, it might be very difficult to account for withholding tax on such payments because of how we have subscribed to them and how we use them, and just practically how to withhold when you are making a card payment. So then it will require us to consider whether we have agreements with providers, service providers along these lines, and what those agreements say. Most of the agreements that we have seen from non-resident software and license providers would be negotiated gross of tax. So gross of tax requires that you withhold the tax, you bear the local taxes yourself, and you remit to me what was agreed in the agreement. So if the agreement required that you pay me $1,000, then you can't pay me 80, having withheld 20%. You're supposed to pay me $100 and you remit the taxes and bear the taxes on your own. So we see that the travel industry space might be affected by that because of the requirement to gross up. So what we have presented next is now the applicable rates that apply, the resident rates and the non-resident rates that apply given the double tax agreements that we have as a country with other countries. So we need to watch out as we are withholding these payments now that they have been brought to withholding tax, whether we apply the correct rate if we are procuring, say, the software from a country like United Kingdom, where royalty is subject to tax at 15%, versus if we are procuring this software from South Africa, where royalty is subject to tax at 10%. And in the absence of a double tax agreement, then most of these payments, withholding tax and management and professional fees on royalties and management fees, are subject to tax at 20%. I think next what I've discussed here is what we called our significant economic presence tax. It is not a new tax. It was not in the Finance Act. But the reason why I have set it out is for the purposes of the non-resident players who provide us with these platforms and tools. So back in 2022, we introduced what we call our digital services tax, which was later repealed in 2024 to introduce significant economic presence tax. And essentially, this is tax that applies by a non-resident person who is earning income from Kenya through provision of services over a digital marketplace. So your likes of platforms are considered digital market services. And one of the services that are listed to be under the ambit of significant economic presence tax is online ticketing services. So you'd find that non-resident persons who offer this kind of services and platforms in Kenya are already registered and account for the significant economic presence tax, where they account for taxes at 3% of their gross turnover. Part of the exemptions within this SEPT regime is that payments that are subject to withholding tax should not be subject to SEPT. So then we find ourselves in a very interesting position with the expanded definition of royalty, because royalty requires that we account withholding tax on payments to online ticketing services. Yet, Section 12E of the Income Tax Act that provides for significant economic presence tax for such non-resident players provides that where withholding tax is accounted for, SEPT should not be accounted for by such persons. Then it sort of gives us a contradictory tax position, and regrettably, I don't think I have answers on this call. Probably what we need to do as an association is to approach KRA and get a better understanding of how they intend that the royalty aspect and the withholding tax aspect applies, together with the non-resident persons who are already accounting for this tax called significant economic presence in Kenya, because ideally you should not be subjected to the both of them. Another proposal that we have seen from the Finance Act on the Income Tax Act are certain incentives which have been provided to the national airline, and it's called the National Registered Carrier. So we have seen a lot of incentives, and we all know that would ideally be KQ here in Kenya. We have seen a lot of incentives that have been expanded. So one of them is around withholding tax. So as we have seen earlier, payments relating to card payments, payment network, payment card schemes, payment processing systems, switching, clearing are subject to withholding tax when it's made by a resident person in Kenya to a non-resident person outside Kenya who provides these services and platforms. However, there is a specific and special carve-out for the national carrier payments to such people. So even payments for global distribution systems that are applicable to tax when another travel agent or another airline is making payments to a non-resident person would be subject to withholding tax. The national carrier has been exempted from such payments. We have also seen that employees, non-resident employees of the national carrier who are engaged in duties performed outside Kenya or international transport operation for the airline are not subject to income tax in Kenya. So this one sort of protects the non-resident employees, either crew staff or the pilot and such staff, from taxation of the income that they are paid by the national carrier, in this case KQ, from being subject to tax in Kenya. Another very significant expansion that we have seen around withholding tax is on commissions to non-resident agents. So any commission paid by a resident air transport operator to a non-resident agent in order to secure tickets for international travel has previously been exempted from withholding tax. So we saw a very interesting expansion in this act, which went beyond just travel to capture transportation services. So then that means if I'm engaging a non-resident air transporter or transport operator for commission basis to now carry freight, cargo over and above just international travel or passenger travel, then such payments would not be subject to withholding tax. So those are some of the key income tax changes that we have seen from the Finance Act that have affected players in the travel industry. So we will quickly go through the VAT changes, and I know this is where probably we'll have a lot of questions, and then the tax administration changes. So on the VAT changes, what I have outlined here is really the current regime, how VAT has operated in the past for the tours and travel operators. So the services of a tour operator is exempt from tax, from VAT. However, in-house services supplied by a tour operator are not part of that exemption that has been provided under the first schedule of the VAT Act. And what we saw from this act is because of the general ambiguity of what in-house services entails, there was a definition to clarify that, that issue, and we'll further discuss it. And with regards to transportation of passengers, so transportation of passengers by means of conveyancing, so if you're using public transport or you're selling me a single seat within a bigger means of conveyancing, has always been considered exempt. However, when I hire, I charter, I lease a vehicle for purposes of transportation, then that is VATable. So that has really been the lay of the land for VAT transactions within this space. Here I'm going to summarize the VAT changes that we saw from the Finance Act. And one of the very important changes was an introduction of paragraph 25 of the first schedule, which sort of defined who a tour operator is and what in-house supplies entailed. So a tour operator has been defined as a tour or safari operator licensed as such by the competent authority responsible for regulating and overseeing the tourism sector. So when you're registered by the Tourism Regulatory Authority, then you are considered a tour operator, and hence your services of a tour operator are exempt from VAT because you sit within the first schedule. So you don't need another VAT exemption certificate to provide to show that you're exempt because you have been exempt by law. And then it went further to define in-house supplies. So how that section reads is that the services of tour operators excluding in-house supplies. So it then means that if in-house supplies have been excluded, then they are not part of the exemption and therefore they are VATable. So of course there have been a very big contention as to what in-house supplies relate to. And so this act provided clarity that in-house supplies are supplies made from tour operators' own resources, or if you buy them from a third party, you don't alter them so materially that they become substantially different. So that clarity, as we will see from the several cases that have been determined at the tribunal and even went to the High Court, what exactly then becomes VATable within in-house supplies and what is exempt. The other two changes that we saw from the VAT Act include the subjecting to tax to VAT payments, fees charged by payment service providers for the purposes of processing, settlement, aggregation, and gateway services supplied by payment service providers. So where you are using a gateway or an aggregator solution in completing or collecting ticket fees, then the fees that they earn from that supply that they have made to you will now be VATable. So what normally happens is that fee might be pushed to you as the consumer because you are supposed to pay for it as part of the fee because VAT is a consumption tax. Another very important clarification that was made in the VAT laws, which might apply to the tour and travel space, is the fact that employment costs which have been procured through an outsourcing arrangement are now not subject to VAT. So I will give an example. Some of these hotels and lodges in their peak season normally get casuals. And how they get casuals is they go to an outsourcing firm and tell them, supply me with casuals or supply me with drivers or supply me with this kind of people because I'm at a peak season. And then in exchange for that kind of supply, you are required to pay management fees. And that management fees would include the labor costs, so their casual wages and salaries together with a management fee. So previously, without this clarification, VAT was subject to tax on the entire bundle of fee. So if you are paying a management fee that is 300,000 and 200,000 relates to the labor costs and 100,000 is the management fee for the outsourcing company, then you would subject VAT on the entire 300. So this clarification is very important because what it has done is it says the disbursement and pass-through costs such as the labor costs and staff costs are not subject to VAT. Only the service fee is subject to VAT. These are some of the other VAT changes that we have seen. And I think a big win is that now for some out of the country, you're allowed to up to $2,000 baggage limit in USD over the historical $300. So the issue of customs is now should be a thing of the past because now the threshold has been increased to $2,000. The rest is on refund of bad debts. The timelines were previously 3 to 2 years. In 2025, in 2026, we saw that if you have VAT on bad debts, where you charge someone VAT and you paid and they have never paid the fee, then you can go to KRA within now 3 years. It changed from 2 years to 3 years. You have up to 3 years to say that the VAT is a bad debt, and you can go back to claim it. So these ones we have already discussed. We saw a bit of changes where items that were previously exempt have now become standard rated. We have discussed the issue of aggregator fee or payment service provider fees. And the rest are issues to do with now the aircraft and their spare parts that were previously exempt. Now they'll be standard rated and subject to VAT at 16%. There was a very good exemption for companies developing and constructing tourism facilities and recreational parks, which had exempted the cost of construction for such parks and facilities. That exemption was removed, and now they are subject to VAT at 16% on goods and services towards the construction of such a facility. So these are some of the issues that we saw were in the bill, but were subsequently deleted. We do not need to belabor the point because most of them really don't affect us, except the 16% on mobile transfer services and M-Pesa payments. That one we discussed earlier on. So lastly, we'll go through the tax procedures amendment. And what we saw in the tax procedures amendment is there are some good wins for taxpayers, including all of us here. And one of them is that the amnesty has now been extended. We have an amnesty currently running that assures us of 100% waiver of penalties and interests if the principal tax has been fully paid before 31st of December 2026. And it relates to liabilities up to 31st of December 2025. For those who have late filing and late filing penalties, the 20,000s, the 10,000s, the 2,000 on your individual PINs, what you'll notice is if there is no principal tax due, those ones are automatically being waived. And if where principal tax is due, there is room to go and negotiate with KRA for a payment plan so that you ensure that you have paid your liabilities before 31st December and you'll get a full waiver. There was also another waiver provision that was introduced that relates to system malfunction penalties. So where maybe due to a delay in iTax or iTax erroneously imposed a penalty on your ledger, the commissioner has powers to waive up to 2 million of such penalties. And then now from a KRA's point of view, and this is where digitalization and the technology-driven tax compliance framework has been brought into play, we see that now we have two very important things which we need to highlight. The first one is the aspect of pre-populated returns, is that beginning 1st of January in the following year, 2027, then KRA has a mandate to pre-populate our returns using the data that they have. And a lot of this is e-TIMS data and withholding tax data and the data from customs. And once they pre-populate that return, taxpayers have a window of 2 months to confirm or amend it. We also see that the taxman is now able to issue data-driven assessments, again from third-party data. So there's a lot of integration and live transmission of systems data to KRA. And when this is done, then within 30 days, the Revenue Authority will provide you with their findings. And after that, you are allowed to respond to the findings. And if the findings are confirmed, then the process takes the tax dispute resolution framework that is already existing within the Tax Procedures Act. Another very important change is that we saw the penalties for e-TIMS, and I know e-TIMS is a big thing for us in this space, and it's what I'm going to discuss next. Another issue for e-TIMS was that the penalties for e-TIMS have now been reduced to 10,000 for individuals and 100,000 for companies, or 5% of the tax that is due. Previously, it used to be at 1 million for whether you're an individual or a company. And of course, in part of our lobby efforts, we were saying that the 1 million penalty is very high because e-TIMS has not been fully rolled out and people are still integrating into the system. So I think before we go into the landmark judgments, I would like to discuss e-TIMS. So that is what I have projected on my screen now. And we say that your invoices are now KRA's evidence. A lot of us who are in the ticket issuing space, we all know that airline passenger ticket is excluded from e-TIMS as a requirement of invoicing. The challenge and the feedback that I've received is that the customers who we issue airline tickets, will always demand that we still want an eating support, because from where they sit, they are aware that any payments they make, unless they are eating supported, will not be eligible for deduction. So if I go to a travel agent today and request for an airline ticket, and I pay 120,000 for that airline ticket, money coming out of my company without eating support, I will not be allowed to deduct it. And that has always been the challenge why people will come back to you and ask you for eatings. I think the law is clear, and the law expressly excludes airline tickets. And so upon filing of my returns as the person who has consumed an airline passenger ticket service, I need to be able to put it in a place in the return that will not be subject to auto-validation, and probably just describe it as airline passenger ticket, or put it in one of those tabs that don't require eatings validation. However, for other tour packages, safari packages, commission, service fee, transport arrangement, anything else that is not excluded from eatings is then subject to eatings invoicing requirement. So some of you here could be registered for VAT, others could not. But where you offer a service, even if you are not VATable, because you have not met the threshold and you're not registered, then that other service that is subject to eatings regulations is required to be on eatings. And the second issue that we see is there are a couple of other very informal and fragmented payments in your ecosystem that might not get eatings. So when you're paying guides, when you're paying drivers, even when you're paying some of these park fees, we have always had a problem with the government, and we actually included this in part of our lobby. The government requires us to document our transaction on eatings, but the government itself is not issuing us eatings. If I go to Nairobi Museum and pay for that ticket, I see now they're giving us eatings receipt, but many other places don't give us eatings receipt. And even while you've been given an eatings receipt, you need to insist that it is in your PIN. So you provide your PIN for it to be transmitted. If it is not transmitted on your PIN, then it is as good as you didn't procure that supply or that service. So some of these very fragmented payments that don't have eatings receipts, like drivers, guides, or cash payments in our ecosystem, then there's an opportunity to do reverse invoicing, where you initiate the invoicing yourself as the consumer of that service. But the supplier has to confirm, and they'll require probably their ID or their PIN for you to reverse invoice. So we see that because of the fact that we are moving into very automated returns and pre-populated returns, then the only data that will be pre-populated is the data that KRA knows and KRA is aware about, and that is the eatings data. So in the absence of eatings compliance, then most of us will have probably a lot of sales with very few expenses because we did not get eatings receipts for those kind of expenses. Or if someone withheld on you, you will see that your ledger or your return shows you have more income than the one you really want to declare. So then what we need to do is to watch for this kind of watch for the January mismatch or the January deadline where pre-populated returns will begin from next year. And as we do that, we need to run internal checks to make sure that we are keeping our records well, we are running our sales on eatings that are not excluded from eatings, and we are also, to the best of our ability, having expenses that are eating supported. The moderator, if you'll allow me, I would like to just highlight two cases which had included as part of my discussion because they will form part of our conclusion, and we can close it at that for questions. So I have discussed the issue of interchange fees and professional fees. So that came following the Supreme Court ruling on the ABSA case, formerly Barclays. And while the courts, including the higher court in Kenya, the Supreme Court of Kenya, held that interchange fees and merchant service fee do not form part of management fees and therefore not subject to withholding tax. Following that ruling, we saw a change in the Finance Act, and that's when the same were brought to withholding tax. This is a very interesting case also, which then led the change to Section 13 of the VAT Act that carved out the pass-through cost and the staff cost from outsourcing services. So again, there were several cases that were parked at the Tax Appeals Tribunal at the High Court, which entailed the same thing, where you are outsourcing a service and the courts held that VAT is subject to tax on the entire payment. So following a lot of lobby and contradictory decisions from High Court and TAT, then that clarity was provided. And now where the industry engages casuals and people on a short-term basis through an outsourcing contract, then VAT is only subject to tax on the service fee and not the disbursements such as the salaries. I think this is a very important case which I'd like to highlight, and the decision came out early this year, sometime in February. It is around how we negotiate contracts with foreign and non-resident persons. So it's a case for Travelport Services, and Travelport is a Kenyan company in this case, Travelport Kenya, which is part of the bigger Travelport group that provides GDS services for flight booking, including for our local carriers. And so the KRA assessed them 2.47 billion for corp tax, VAT, and withholding tax on the basis that they crystallized what we call a permanent establishment. They were acting as a dependent agent for the UK office, and they were negotiating contracts and getting into contracts that are binding with customers in Kenya on behalf of the UK entity. So the way our Kenyan laws are structured is that where you are carrying out contractual services that then become binding or that bind you on behalf of the foreign principal, then you have created a branch or an extension, what we normally call a permanent establishment, an extension of that foreign entity in Kenya. And therefore, the income that has been earned in Kenya through your activities and engagement then would be considered taxable in the Kenyan entity. Typically what happens is that that income goes to the UK or the non-resident person, and then the Kenyan entity just earns a management fee for their work. But because we have crystallized what we call a permanent establishment through this dependent agent relationship, then we say all the income that Travelport UK earned from Kenya should be subject to tax in Kenya through this Travelport Kenyan entity. So the case was before the tribunal, and while Travelport was the appellant and they were appealing against the KRA's assessment, the tribunal held that those taxes were due in Kenya. So this is important for members who have contracts with non-resident agencies or non-resident persons. You need to review those contracts so that you see that they're not binding you, and you then creating that risk that the income earned by the non-resident person becomes subject to tax in Kenya. I think the last one is this issue for VAT on tour operator services. I tried to look whether there is any recent case after Lewa. I know Lewa Wildlife Conservancy case was an old case. In fact, it was determined in the pre-2013 VAT legislation, our repealed VAT Act Cap 476, which had more than 2 schedules. So it was determined in that previous regime. And while the issue in question was whether park fees is subject to VAT, they also explored how the VAT Act was then worded. which is a similar provision to our current paragraph 25 of the first schedule of the VAT Act that provides that tour operator services, excluding in-house supplies, are exempt from VAT. So while this case was determined on the premise of legitimate expectation because the Lewa Wildlife Conservancy had previously obtained like a private ruling from KRA, which provided them this legitimate expectation that park fees were VAT exempt, the judge also went into the details of what in-house supplies looked like and whether park fees were part of in-house supplies. And the fact that park fees are not in-house supplies, in that they are not made by the tour operators' resources, or it was bought from a third party, but it was materially altered, there's nothing you alter when you pay park fees, then it was also considered as part of a tour operator service, which was VAT exempt. So we see that the Finance Act of 2026 sort of clarifies what in-house supplies are, and therefore we need to review our transactions to see how we sit within the definition that has currently been provided and whether those ones now will become vatable, and to the extent that we meet the 5 million threshold, we register and account for VAT accordingly. So as I conclude, some of the considerations and checklists for compliance as we move towards year end and into a very digitally compliant regime in 2027 is that we need to audit all our platform contracts, because we have seen now with the expanded definition of royalties, there is a very far-reaching definition of what a royalty is, and probably almost everything that we pay for now for use of a platform, a payment processing system, is considered royalty. So we need to review those clearly to see the withholding tax exposure that we will be carrying in months to come. And then, as I have emphasized on the issue of permanent establishment and entering into contracts that bind foreign principals, we need to see how those contracts have been drafted and whether there's any liability that will be accruing to the foreign principal through our services rendered here in Kenya and engagements. It's also good to consider some of these pass-through costs, whether they will form under what the law has now exempted as disbursements, and whether VAT will be payable only on the fees. We've emphasized the issue of ETINs, withholding tax, and revised invoicing for the informal suppliers that we have. You know, ETINs is a big thing, and part of even what we try to lobby is to lobby for unique sectors. And maybe it's a conversation to have with KATA whether there are certain payments that are so unique that we can't reverse invoice, or they're really below the threshold, and whether ETIN's requirement should actually introduce thresholds so that we say any payments below 5,000 are not subject to ETINs, or 2,000 or 1,000, so as to just help compliance and reduce the risk of having these costs being disallowed on omissions that are really outside our control. Then with the pre-populated returns and the online assessments, we need to keep watch that our ledgers and our financials are in check, so that we are not caught unawares by any sales that KRA says we earned through a withholding tax regime, or an expense that we paid and we did not claim it. And lastly, if there are any penalties and interests, then we have now 5 months from beginning 1st of August to regularize the same and take advantage of the tax amnesty. And with that, ladies and gentlemen, our presentation has come to an end. We conclude with a thank you and we say, welcome, let us talk before KRA talks to you.
All right, thank you, Wangoi, for the presentation. We will now move over to the questions that members shared earlier, quickly before we can open the floor to them. Let me share the questions. Yeah, and the first question, Wangui, is a question of what the key tax compliance requirements are, the taxation rules that travel agents should be aware of, and the obligations of newly established private limited companies that have not reached the 5 million in sales. So are such companies required to pay 16% tax on their profits?
Thank you so much. I have actually just done a quick skim on the questions, and I see most of them are part of what we've discussed in the training. So I like that. I hope I have been able to address some of these as we went through the presentation. But to answer the first question, so first let us clarify something. VAT is the one that is at 16%, and VAT is not on profits. VAT is charged on supply of goods and services. So as we were discussing, probably in-house supplies by a tour operator, and we said that those are VATable, or that slide which I presented and said the current regime, and we outlined a few things that were actually VATable, then it means if you have reached the 5 million threshold, you are required to register for VAT and account for VAT on those supplies. So if you are offering car hire services as an in-house supply, if you get packages and you materially alter them, or you're offering accommodation, or you're offering meals, then those are VATable supplies. But your service as a tour operator, where you are earning commission for that, then those services are VAT exempt. So you have no business registering for VAT and charging VAT. And some of the other compliance requirements and taxes that apply to you are what we have discussed. So there is income tax that is now subject to tax on profit. And that is paid through an installment mechanism, where you pay the first installment, the second, the third, and the fourth on the 4th month, the 6th month, the 9th month, and the 12th month, on the last day of those months. And then if you did not do installment, then you do what we call a balance of tax, which you pay by the last day of 20th of, by the 4th month of following your year end. So that's when you'll find that most of us who are December year ends, by April, we pay taxes for the last year. If you happen to pay your taxes in June when you're filing your return, you will get a late payment penalty. So it is good that now, if returns are being filed by April, then you pay your taxes then. The other big thing that we have discussed and spent so much time is around withholding taxes. It is part of an income tax regime, and then it now applies to those detailed payments that we have discussed. Any platform you're using, any software you're using, and the liability to withhold taxes sits with the person making the payment. So in this instance, if you are the travel agent business and you're paying for a platform or for a ticketing online platform, then you withhold the tax before you pay. Because any now non-compliance penalties will go to you. They will accrue to you, the person who is the payer. Over to you, Francis.
All right, thank you. Maybe we can move over to the question on how to handle petty cash expenses that are not processed through ATMs.
So that is a very, very big thing. And unfortunately or fortunately is that it is not unique to only members of KATA. It applies to all of us and all of us as taxpayers at the moment with the ETIMS dispensation. So the unfortunate bit is when ETIMS was rolled out, there was no place for a threshold. And we saw like Uganda, like Rwanda, in rolling out electronic tax invoicing, there was a bit of threshold. So in the absence of a threshold, then the requirement is all payments, all business expenses have to be supported by ETIMS. And to the extent possible, it is very hard as well. And I'll give you an example. So say you have an office rider that you normally send and they take public transport and they go to town to complete some payments, to bank some payments, or they go to the airport to pick people and do all those manner of things. So that payment could be 200 today, 250 tomorrow. In a month, in a week, it's 1,000. In a month, it's 30,000 or thereabouts. In the absence of ETIMS, that payment never happened, or that expense didn't happen. So I don't have an answer of how to account for petty cash, but what I can say is, to the extent possible, let us have most of our expenses on ETIMS. I know some people have adopted reverse invoicing, where you will not give me an invoice, but I will pay you. So I go to the 222# and do a reverse invoice mechanism. The question is whether will matatus agree to be reverse invoiced? Possibly not. And so from where I sit, I say this always provides an opportunity to engage KRA and highlight the uniqueness of our industry and our business, and urge them to really, really consider probably a threshold or a petty cash expense somewhere where I'm not allowed to account for that on ETIMS, because it is really just how the economy is structured. In most of the places where probably tours operate, say Meru, Kakamega, those places ETIMS has not been embraced as much. So most of the services you will procure from such out of town or out of Nairobi will not be ETIMS supported. So it is just to not to tire, but to really, really engage KRA. And we can always do that now through KATA as an umbrella body. We have done that before for other associations, and to just paint a picture of how unique the sector is, and also emphasize how difficult and complex it is to get every payment on ETIMS.
All right, thank you. Then there's a member seeking clarity on the requirements, the procedures for ETIMS on purchases and sales, and also asking what will happen to them if their client do not provide KRA pins for the ETIMS invoice.
So the procedure for purchase and sales, so as I earlier alluded to, for sales, unless it has been excluded within paragraph 10 of the ETIMS regulation, which excludes payment in the nature of airline ticketing, salaries and emoluments, interest, capital deductions, accounting adjustments, and they're listed there. So unless you have been expressly excluded from ETIMS requirement, then all your other transactions should be subject to ETIMS. And the clarification here is not VAT. So whether you are VATable or not, you are still required to run your sales through ETIMS, unless of course it is airline ticketing. And for purchases, it's now your duty, as you go to procure anything, you've gone to the supermarket to buy office supplies. At that point of sale, tell the supplier your PIN. You have gone to pay for a professional training. You have paid KATA for a membership fee. At that point, request for an invoice with your PIN that is ETIMS supported. because that is what now will be transmitted as your sales and purchases. The third part of that question was what again? I've discussed sales and purchases.
The implications of the client not providing the agency with the PIN.
So in the absence of you not providing the PIN, and yet you have paid for a good or a service, most of these places will still give you an eTIMS invoice. And how you know is that it has that barcode. And if you scan it, it will take you to a KRA website. So to the extent that your PIN is not on the face of that invoice, that transaction is recorded to have happened by the supplier because they supplied a good or service to someone. But to you, the travel agent who is the consumer of that service, because your PIN is not reflected on that transaction, it means you are nowhere in that supply. So if you don't provide your PIN at the point of receiving a supply of good or service, then you are not able to deduct that expense, which is an allowable business expense. And what that does is you will report higher profits and you will not have supporting expenses. So it is really, really critical and paramount going forward that all your expenses that you pay for, you provide your PIN and you make sure they have captured your PIN correctly. And if you go into your iTax, you will see that data is already there. It's already captured there, and at the point of filing, it is just for you to verify.
All right, Wangoi, this next one I'll read verbatim. Does eTIMS affect balance sheet items such as accruals and provisions, where eTIMS records include both profit and loss and balance sheet items? How should these be separated when filing tax returns? Additionally, how should Forex differences be handled in relation to eTIMS?
Okay, that is a very, very good question. And it is a real scenario. Thank you for that. So eTIMS affects your sales and affects your purchases. As I had earlier alluded to, paragraph 10 of the eTIMS regulation provide a list of the things that are not subject to eTIMS. And some of those things are accounting adjustments. So your accruals and your provisions fall within accounting adjustments. Your depreciation is an accounting adjustment. Your wear and tear, your capital allowances, those are accounting adjustments. They will not form part of your eTIMS requirements. Those ones you are free to pass them. If you put in a depreciation line in your P&L and at the time of filing the return, it will not be a line item that will be subject to validation by KRA because it is already considered outside validation. The other issue of eTIMS records that include both profit and loss and balance sheet items, I will give you an example. If you buy a motor vehicle, for example, and you go to CMC today or Toyota Kenya and you buy a double cab pickup, they are required to give you an eTIMS invoice for that double cab pickup. That motor vehicle is a balance sheet item and it will sit, you will record it as a purchase of motor vehicle as a balance sheet item. If you buy office consumables, you go to Carrefour and you make shopping for office consumables and you pay and you put your PIN, those are ordinary revenue expenditure and they will sit in your P&L. So at the point of filing, then you will prepare your financial statements and you will prepare your tax computation. And you will throw that my motor vehicle, which I bought, is a balance sheet item. While it has an eTIMS invoice, it will sit in the balance sheet and it will not automatically be deducted as an expense line. So when we complete our tax form tab in the return, we will now key in all these issues that are subject to deduction from a P&L perspective. And what now KRA does upon validation is they look at how much you've claimed versus how much has been transmitted to you And that motor vehicle is a good example. KRA could have captured that motor vehicle because it's on eTIMS as a business expense. But because you have put it in the balance sheet, it will not feature in your P&L. So at that point of filing, then there's a bit of reconciliation to do as to say this balance sheet, while maybe KRA you have captured my eTIMS purchases as 5.2 million, 3 million related to a motor vehicle. It needs to be a balance sheet item. 2.2 million related to office supplies, it's a P&L item. So then that takes us to this issue of returns will be given to us before we file for the purpose of that kind of exercise. This year when we were filing, we didn't quite experience that problem to that magnitude because capital items were on eTIMS, yes, but they sat in the balance sheet and we did not deduct them. So there's a way even when you file, the validation exercise that is happening behind the scene is able to separate these are P&L items and these are balance sheet items. The last thing of Forex is Forex movements are, of course, they are not eTIMS supported. They cannot. It would fall under, things like interest. And those ones you are able to just book them as an accounting entry because even for Forex, we normally deduct and reverse the position next year. So unrealized Forex gains, we deduct. Next year, we subject them to tax when they're realized. So those are part of accounting adjustments which will not be subject to eTIMS.
All right, clients are increasingly requiring eTIMS invoices. So how will we structure the line items? Will we separate airfare, treat it as non-taxable, and now the agency fee, we subject it to VAT?
I know this is a contentious issue, and we've had a communication and a discussion around it even with the executive team at KATA. And I think the sensitive part is as an agent, when I give you that ticket with $1,200, no, my commission is there. So when I start to separate and say the airline ticket is only $1,000 and $200 is my commission, then it is negative for business, so to speak. Because I will see that you're now charging me $200 for commission. Why not go and get someone who will charge me $100? Or why not book it myself and pay only $1,000? So then the question becomes, is it possible to then say, when I'm selling an air ticket, that is all I'm selling? The issue of whether my commission is there or the airline ticket is separate from my commission is not up for discussion. You, when you come today and ask me for an airline ticket, I will give you an airline ticket. And because the law has said clearly that airline tickets are exempt from eTIMS, that should be your defense line. When they ask for eTIMS, you just give them paragraph 10 of that regulation and tell them airline tickets are not subject to eTIMS requirement. I see there is a comment from one of us here. I don't know whether you can read it, about a training that was done by KRA in the past.
All right, they say as per the training done by KRA staff, for the non-IATA agents, they are advised to report on eTIMS only. Service fee or the commission received, since the rest of the funds goes to the airline. Maybe maybe the person who commented can shed some light. Christine?
So is the clarification that non-IATA's member, you are required to separate the airline ticket and your commission, and then for IATA members, you don't separate and it goes as a whole eatings? I see, Christine, you are unmuted. Go ahead.
Yes, as per the training we were given when the e-teams was introduced, we were advised that since the rest of the amount goes to the airline, we should only report the service fee or the commission received from the service rendered, either it's an air ticket or a car hire or hotel, all those. We should only report the service fee or the commission received. So I believe this is in clear also, since we got the instructions from the KRA team. Thank you.
Thank you, Christine, for that clarification. And so then it means if I am coming to you for airline ticket services, you will give me two invoices. One invoice will show me just the airline ticket will be non-eatings, and your service fee or commission will be separate, and you will raise an eatings for the same. So that is an acceptable route if you are willing to disclose your service fee or commission. Other proponents have handled that. Everything actually goes to the airline. I'm not sure to what extent that is true, but then if there is a service fee, the service fee is subject to eatings, and it's not subject to is not part of the eatings exclusions. And the advantage is those are part of the tour operator services, which are excluded from VAT. So they are not VATable.
All right, we move over to these few questions remaining, then we can open for the members. Tour vehicles. How owning and operating a tour van, whether it has tax implications.
Yes, so as per the definition of in-house supplies, then anything that you are supplying as a service or a good as a tour operator in-house, like as your own resource, then that is VATable. And I've handled a bit of audits where most of people in the tours and travel were not subjecting VAT to the transportation services of passengers. And the KRA has always taken a position that because when you give me that vehicle, it's a chartered vehicle or a hired vehicle. We don't take it like a matatu where all of us will board and just pay for a seat. So in that regard, then your transportation services become VATable. And if within a year of income, you have reached the 5 million threshold, you are required to register for VAT. So what the players need to keep watch is, to what extent is this kind of in-house supplies meeting the 5 million threshold? If they meet, you register for VAT, and then you also are allowed to claim expenses relating to that vehicle and so on. So when you fuel, you get a VAT receipt. When you service, you get a VAT eatings receipt. Then it offsets against the VAT payable. And of course, even without registering for VAT where you have not met the threshold, then you are required to account for, you're supposed to get eatings expenses towards those kind of expenditure so as to reduce your tax payable at the end of the year.
All right, on payment gateways and card transactions, are agents required to withhold tax on the merchant fees or is it the responsibility of the bank or the payment gateway?
So also a very, very good question. And as I had earlier said, is the practicalities around this administration of withholding tax is going to be a big problem. But yes, you who is the consumer of that service, if you are the one making the payment to the payment gateway and not me, the client, then you are required to withhold tax on such a payment gateway. If you're the one who is enjoying the online software or the online platform and you are paying for the same, you are supposed to account for that. As to merchant service fee, it affects people who use point of sales. So if I have a point of sales device, then there is an element of merchant service commission which is deducted from my income by the bank. But because I'm the one sort of paying, and I'm using paying in quotes because it has been deducted from my income, the obligation to withhold sits with me. But practically, we have said, and of course, KATA is very much aware, despite having passed this law last month, is that the practical challenge of accounting for withholding tax on merchant service fee is almost impossible. If I come to you as FCL today and I swipe my card, you don't even know how much the bank is going to earn as merchant service fee. So how then do you compute withholding tax on that merchant service commission that the bank has earned from that card transaction? So it is there in law and it's a requirement for us to withhold, but it is almost impossible because of those reasons. But for these others that I see have been listed, the Amadeus, the Sabra, the Expedia, Booking.com, those platforms trigger a 20% withholding tax under the royalty category. And as I have highlighted in the report, if those platforms are from the US, we don't have a DTA with the US, you pay at 20%. If they are from countries that we have DTA, France, Germany, South Africa, UK, you deduct based on the preferential DTA routes. And on iTax, it's there. If you put a country, it will give you the right DTA, the right DTA rate. However, what we need to watch out is, did we sign contracts with these people? And if we did, and the contracts say that their payments are gross of tax, then it means they want their money as drafted in the contract, as indicated. Any other tax that is applicable in your country is yours to bear. So we'll sort of be paying the fee and the extra 20% to KRA because the contracts were negotiated on gross terms. So I believe that one has answered your question 9 and question 10.
All right. The last question is on tax treatment of staff per diems for the tour drivers, for the staff traveling across East Africa. What documentation does KRA require during an audit to substantiate per diems as non-taxable allowances rather than the pay taxable benefits?
Very good question as well. So last year we saw an increase of the per diem reliefs. So previously and for the longest time, per diems have been 2,000. Now last year they were increased to 10,000. And because these per diems are part of staff emoluments, so they are eatings exempt. You can't charge someone eatings on per diems. So the document that you require to keep is at least they need to sign a sheet to say they received per diem. And what that sheet would say is they were out of their operating jurisdiction for this number of days. So if they were there for 3 days, you are allowed to give them per diem up to 30,000, which is deductible in the eyes of the law because it's 10,000 per day and not 2,000 as it previously was. So you just need to document through probably a log or something internally that you can prepare as a memorandum or a sheet for them to sign and say they were out of duty on these days, you paid, whoever is receiving signs, and whoever is, the finance in charge probably signs also as a part of internal control.
All right, now moving to the few questions on the chat. What is the best way to handle business expenses such as mechanic charges, motorbike charges, driver allowances when an ATM's invoice is not provided? What is the recommended way forward in such cases?
Mm-hmm. So the rule of thumb is if the expense does not have an ATM's invoice, it didn't happen. I think that is what we really, really need to emphasize. That is the rule of thumb, and that is how the law is currently worded. That without ATMs, you are not allowed to deduct that allowable business expense. So what I have seen businesses do is to take the hard call and say, I really like my mechanic, but because he doesn't give me an ATMs, I will go to a mechanic who will give me an ATMs. So some of it has required that you change suppliers. Another internal control rule that businesses have adopted is you tell all your suppliers that we shall not pay you before you give us an ATMs invoice. So because they will want to be paid, they will have to get how to get an ATMs invoice. Another one a strategy that you can handle and employ is what we call the buyer initiated invoice. So you go to the mechanic and you tell them it's okay, I know you will not give me an ATMs, but allow me to raise the ATMs on your behalf. So within KRA's websites, you will see when you just Google buy initiated invoice, it is *222#, *222#, and you just follow the prompts. It's very simple and you can do it on your phone. So you then initiate that invoice on behalf of your supplier, like this motorbike repairer. It does not require the PIN of the buyer. It does require the PIN of the buyer. So then it will mean that the people who you are trading with at least have to be within the KRA's radar and they have a PIN. And then once you initiate, that person approves and they get an electronic invoice, even it comes to message. So that is the way we have advised in the past and how we see as strategies that businesses can employ. Again, I will close by saying the rule of thumb, if it is not ATM supported, it did not happen. So we then need to strive as much as possible to procure ATM supported supplies and invoices.
IATA does not provide agents with ATMs. Will they still be able to deduct as expenses? And also, how should agents treat discounts on sale? How should that be accounted for?
Okay, I think for IATA, if it is a non-resident body, then rightfully they cannot give you an ATMs invoice, and so will the case be for booking.com and for Amadeus if you're paying to non-resident bodies, because imports are excluded from ATMs. They are giving you an invoice based on the law of the land where they operate. So the law of the land there does not recognize Kenyan law require ATMs. So imports is one of the expressly excluded categories of invoices or supplies that are excluded from ATMs. So with your IATA invoice, you still can claim that expense because it's an import. I think I just want to mention one of the things that we've seen that we don't get invoices, of course, are government fees or government payments. Those ones the government is still not issuing ATMs, and it's a local agent. You need to deduct. VFS does not give ATMs invoices unless maybe you request. So then maybe we document and see which are these players that we interact with locally that for one reason or another are not able to give us eat-ins, and then through KATA we can see how to handle those. The second question of how should discount on sales be accounted for? A discount on sale is a reduction in the taxable supply. So you only issue the invoice on what you're going to receive as consideration for that payment. So you will only issue an eat-ins, or you will only record your full revenue or sale against what you'll actually be paid. So it will be your original price less the discount, then now you get whatever consideration you shall be paid. And that's what you record for either purchases or sales.
All right, thank you, Wangoi, for taking us through the presentation and handling the questions. Maybe now opening this up to members who want to raise questions for the next 5 minutes. Any clarification, any concern? All right, Kevin. Please unmute yourself, Kevin.
Thank you, Wangoi, for the great presentation. Does that mean, like, starting from next year, KRA will not accept the manual and native expenses?
Yes, Kelvin. So even this year, they said they will not allow, but after a lot of negotiations, discussions, meetings with various stakeholders, they appreciated the fact that it is difficult to have 100% transition, and therefore they allowed a tab for non-eat-ins, and of course the condition was you upload a file based on their format of the supporting documentation to those expenses which you have deducted. As the filing processes were going on this year, they kept saying to next year we shall not allow, next year we shall not allow. And the fact that now the law has been amended with this Finance Act to the Tax Procedures Act to state that every January we will be receiving a pre-populated return, then it is likely that that is the route they want to take. I can't say with certainty whether they will be empathetic and sympathetic enough to allow non-eat-ins invoices, but that is the tone that the Revenue Authority has had. And with the changes in the law that they will even be issuing a pre-populated return, it sort of suggests that that is the route they want to take.
All right, thank you, Wangoi. Thank you, members. Let's take one question, then we close. You can answer. Yes, Patrigona.
Okay. I need to clarify something, like about, we said, airline tickets are exempt from eat-ins. So what I need to know, are we really supposed to, as agents, are we supposed to issue our tickets on eat-ins, invoices, ticket invoices on eat-ins? I need that to be made clear. Thank you.
I think we can take the other one from Jebiha, then I can answer the two.
Oh.
All right, thank you.
Sorry, I
Jibiha,
was waiting for Jebiha's question before he responds to Petrigona.
okay, please proceed, Wangoi, and because of time, we will close it as at this point, and we will share Wangoi's contacts for any further questions that remain. Thank you all for joining. Wangoi?
Okay, thank you so much. So the law is clear. I will say that in as much as it's clear, it can become unclear at some point or a time. So, however, the law expressly excludes the issuance of air ticketing from e-TIMS. So if you are going to issue me with an air ticket, you do not issue me with e-TIMS. And the assumption is, no, this air ticket, you have bought it from an airline. That airline can't give you an e-TIMS. So, and if you issue it, you issue an e-TIMS on that air ticket, then Petrigona, the entire supply of that airline ticket, if it is $1,000, is considered your income. So that is part of the reason why airline tickets were exempted from e-TIMS. Number one, just because of the volumes, the bulkness, where do they get our pins? And number two, because if you, the travel agent, is the one issuing that ticket to me and not directly the airline, then that revenue is considered yours, yet you will not earn the full revenue. So then airline tickets are exempt from e-TIMS. Christine raised a very important point, and we have seen that point also across through the questions and charts. What happens to where there's a commission aspect to that airline ticket, as the case may be? So if you're going to earn a commission, then commissions are not subject to e-TIMS exemption. That commission is your income, and that is the only way it can be reported as your income if it is e-TIMS supported. If you run all your commissions as an airline ticket and you don't subject them to e-TIMS, then at the end of the year, if that's your key business, your income will be zero because you will not have transmitted any sale via e-TIMS. So the only way you can actually report your sale is if you make it through e-TIMS. And therefore, where you're earning a commission from the sale of an airline ticket, then you might separate, you need to separate the airline ticket and don't give me an e-TIMS and just give me the airline ticket. And your support is paragraph 10 of the e-TIMS regulation. And the extra fee that you earn from that process is then now subject to e-TIMS. And if it reaches the VAT threshold, it is subject to VAT. If you are, someone else has asked whether airline tickets are subject to VAT. They are exempt from VAT and they should not be subject to VAT. So if that's all you're doing, it is exempt from VAT. But remember, your tour operator services is also exempt from VAT. So that commission which you earn as a tour operator to give me an airline ticket is also exempt from VAT. So that's how VAT, e-TIMS, and income tax will play in the scenario of an airline ticket.
All right, thank you, Wangoi, for such an insightful, informative session. Thank you, members, for showing up. We hope these have been helpful. We will follow up with Wangoi's presentation and her contacts for follow-up and guidance on such matters. Thank you all. Have a good afternoon.
Thank you. Thank you for being an active agent. Thank you, KATA, for bringing us together. It's a pleasure. Thank you and bye.